Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for February 21st of 2022. Please see your disclaimer for important information. Well, as we look at our high frequency data for this week, I think one of the key things you're going to notice is a little bit more green in these columns, especially in the week over week and the month over month, and we've gained some momentum here as of late as we've seen kind of the Omicron variant kind of roll over, and we're getting back to, I think, levels that we saw perhaps towards the end of last year after the before the Omicron variant, but after the Delta variant when we were in that lull. So activity's clearly picked up. Obviously a good sign. We've got more flights that are being put back into service, more airplanes being put back into service. So global commercial flight volume is up both in the week and the month. TSA checkpoint data, obviously very strong, which is important to recognize because we're in a bit of a seasonal lull right now with regard to travel after the holiday season, before spring break, before Memorial Day. And so it's good to see that data. Obviously, we're still negative in a lot of these categories relative to before the pandemic, but that gap is narrowing. So hospitality, hotel occupancy is up, restaurant activity is up as well. And so we're really, in those last two categories, only down high single digits percentage-wise from 2019. Steel production, we see that really kind of be a poster child here, if you will, for a little bit of sluggishness in goods production and consumption, so not too surprising there. We are seeing an increase in auto sales, which is taking inventory out of off of automotive dealership lots. So we had a little bit of a hiccup in auto production as these inventories are being worked down. But overall, good trends in the data over the last week. Here's a look at the economic forecast. And so this is a summary, if you will, of various forecasts. And as you can see here, back in December, we were still looking for a first quarter economic growth rate around 4.5%. And you can see how quickly that's changed. Now the estimate is only for about 1.65%. And we continue to monitor this. I've shown this a few times here over the last few weeks, but we want to, we're kind of interested in continuing to monitor this. And so it actually moved down in this last downtick fairly significantly from roughly about 2.75 down to 1.65. And a lot of things at work here. I'd say one thing is that we've seen a pretty big inventory rebuild in the fourth quarter. And I think with the activity in some respects slowing down, although in our high frequency data, it clearly shows that there's more activity out there, but there's this anxiety out there that things are kind of slowing in anticipation of the first interest rate increase. So we're getting conflicting reports here, but the expectation is that things are going to be a little bit slower, and maybe we don't get as much support from inventory, maybe we don't get as much support from government spending, perhaps as we have in the last couple of quarters. This is a global fund manager survey of investor expectations. And this particular question, as it comes to us from Bank of America, it suggests that global fund managers, investors, basically, let's call it institutional investors, are expecting a slightly weaker economy. So this is a diffusion index. It shows us that the net percentage expecting a stronger economy is actually negative. So the preponderance of these managers expects slower economy up ahead. Again, not terribly surprising because we kind of see this in some of these forward-looking indicators, but clearly the institutional side is kind of taking note of some of the changes in these economic growth expectations. Now, on the flip side, I can tell you here by looking at the Citigroup Economic Surprise Index, And just looking at hard data that here in the last month or so, we've actually seen an uptick. So we've seen more positive surprises. So one thing that we've got to watch the risk, that we risk, I should say, is that we get so negative in these expectations that you're consistently then getting beaten on the upside for some of these economic indicators. And that may be the case here, at least near term. Again, there's a ton of anxiety that exists out in the marketplace right now, and surrounding not only the Russia-Ukraine, the Fed interest rate increase, the inflation rate sustainability question. There's a lot of unknowns out there. And so, when you have that kind of uncertainty, you tend to ratchet your expectations down. And oftentimes you have to come back and bring those estimates back up when you realize, well, things aren't nearly as bad as we thought they were going to be. We have a look here at the Philadelphia Fed. So we get these regional Federal Reserve Bank outlooks and assessments, if you will. And so this represents the Philadelphia Federal Reserve region. Again, a bit of a microscope into a particular part of the country. But I think these indicators kind of show what we kind of articulated maybe a couple of slides ago, that activity does seem to be kind of slowing down a little bit, even though we're witnessing more positive economic surprises. But you can see on the left-hand side, you've got the overall Philly Fed index that's kind of trending lower a bit, and then you've got the Institute for Supply Management Index on the right-hand scale, and it's moving kind of in tandem. You can see that there's a pretty strong relationship between these two indicators. And then on the right-hand side, I think this is important to show you that prices paid seem to be flattening out a little bit. So where we had been seeing a tremendous amount of inflation in the pipeline, it still exists, and we're still at a high level, but at least it's not going really higher from here. Again, kind of continuing on this data out of the Philly Fed, a couple of things that I think are really worth noting, and both of these are important in their own way. So on the left-hand side, you've got expected delivery times, and these are going way down. So it tells you that the supply chain choke points, at least in a forward-looking basis, are trending in a much better way. Maybe that these things are beginning to work themselves out, situations not nearly as bad. On the right-hand side, we've got the expected unfilled orders index, and you can see that has trended back down again. Again, both of these seeming to suggest that supply chain issues are working themselves out just a little bit. In these two charts, we've got the National Association of Home Builders indices, and we get this on a monthly basis. So on the top hand side, you've got the market index, and this is just a kind of a aggregate survey. And as you can see here, things have kind of rolled over just a tad here at the beginning of the year, but they're in the aggregate, they're at an extremely high level. So housing industry and builder optimism is still pretty high. And then if you look down below, you've got the traffic of prospective buyers. And so I think this is a function of a lot of things. And we've got a chart on this coming up that mortgage rates are moving up. So housing affordability is an issue. Prices are still relatively high and inventory is relatively low. And so you get the confluence of those things, and you get the traffic of prospective buyers beginning to roll over. But we have such an unmet need and so much in the pipeline right now that I think it's only fair to assume that housing market index for the NAHB is going to kind of flatline here for a little bit. So I just mentioned this a second ago, and so this is really important in the sense that we've got a lot of things that are in the construction pipeline for privately owned housing units, and this is kind of a big aggregation. So just say if you use this as a proxy for what's going on in the single family housing market, you can see here that the amount of new privately owned housing units authorized but not yet started is really high. So there is a pipeline coming, but I think one of the things that's impacting this right now is, of course, some of these supply chain issues where lumber is a little bit higher, maybe somewhat scarce. I know some people have told me that they really can't find windows anywhere right now, in some cases siding, in some cases aluminum for that type of roofing accent, and so but there is a lot in the pipeline. So this is the Freddie Mac mortgage rate survey, and as I mentioned before, we know rates are moving higher. And this is actually pretty current, but it depends also too in what market you're in. And I could say that like right now in the Southwest market, I'm not sure you could find a conforming conventional 30-year fixed rate mortgage for under 4% right now. And because it has moved higher, obviously in tandem and indexed to the 10-year U.S. Treasury, but you can see the dramatic rise in that level. So obviously the pickings were pretty good a year ago if you were either refinancing or buying a new home. And even if you're doing a cash out refinancing, which is typically at a slightly higher rate, that was then and this is now, but clearly we're well below some of these levels that we've seen here over maybe the last 3 to 4 years. But we're getting back now in a range that I think we could be comfortable with for a while. Just that everyone has to get used to these levels after having enjoyed such low rates for quite some time. A quick check-in on the labor market. This is from BKA research, and it shows you, a couple of things. One is the participation rate for labor. You clearly see that that's picked up. We've had some charts that have kind of really dug into the granularity of that over the last few months. And you can see just in the aggregate, we're well below pre-pandemic levels, but we're getting closer to getting back to that point. And you can see, with the shaded bars here representing recessions, that you do typically see participation rates kind of ebb and flow during cycles, and the displacement of all the lockdowns in 2020 notwithstanding, you can clearly see that we're beginning to regain momentum in that. Now, in the employment to population ratio, you can see that that's also recovering. You can see the long trend for that extremely long business cycle that we enjoyed prior to the pandemic. You can see that employment to population ratio was continuously picking up as we had older cohorts stay in the workforce. Obviously, we've seen a lot of retirements, but overall, we are seeing some of the older cohorts in our working age population stay in the workforce here. On real disposable income, the big deal here is that we had a lot of transfer payments from the federal government, pandemic assistance, pandemic relief, so on and so forth. That's really gone by the wayside. Now, what's important about this chart is it represents real disposable income, not nominal, which means this is inflation adjusted rate here. So, and you can see that long trend line going back, roughly 7 years or so. And it shows you where we are, and we're below that. And we're below that for the simple reason that we have high inflation right now. And so, when you look at real incomes, and this is kind of real disposable income is really the true measure of purchasing power for the average consumer. And you can see that we're a bit impaired right now. Again, this is, I believe, temporary is a strong word, but it is an interim issue because inflation will likely go down in the coming months. Maybe it goes from 6.5% to 7 to maybe 3.5. But that's higher than what we've experienced, but it's considerably lower than where we are. And so I think what that does to this particular data series is it kind of puts us back in line. So I show this not to kind of raise too many eyebrows and get people overly concerned, just to say that, that in a sustained period of high inflation, this type of trend is not good. Real disposable income trending lower. You certainly don't want to see that. But I guess my end point on this chart is that I don't believe it will stay in this trend once inflation begins to ebb a bit. Here's the commodity index. We'll start to get into some of the market conversations, both equity, fixed income. But here on the commodity side, we clearly see, another leg up, if you will, in the data. And I'm not sure that, we're gonna see, a ton of reversal here. This is more of an impact into the producer side, whether you're talking about agricultural commodities or industrial commodities. Or some of the kind of the heavy material commodities. But obviously we're going to need to continue to monitor this. It is helpful from an investment standpoint, though, because commodity exposure has actually been pretty additive as of late. And we'll talk about some of what investors are doing and thinking, and how they're trying to make sense of all of this cataclysm of data. Clearly, one thing that they're doing right now is they're increasing their cash balances. And this is something that really they've been doing for the balance over the last year. A lot of it has to do, with new money coming into the market. This is not necessarily being deployed. But we have seen a near-term spike in cash balances. Again, it's just a function of anxiety, nervousness. Typically you see a rotation into treasuries, and you see bonds kind of catch a bid when there's a flight to safety, if you will. I think there is increased concern in the market. There certainly is increased anxiety, which takes place anyway before a Fed tightening cycle begins. But when you add in, the pandemic and Russia and Ukraine and high oil prices and inflation, yada, 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 it is kind of a big cross to bear. And so you do see cash balances moving a bit higher right now. I saw this from Liz Ann Saunders, and I essentially reposted her tweet here. And I think this is important. We've talked about this before, where the year-to-date return of the S&P 500 as of the 17th is about negative 8%. However, we have seen drawdowns in significant drawdowns in a large part of the index. And so the takeaway here is that you've got more than half of the S&P 500 has had at least a 20% drawdown from their 52-week high over the last year. And that's a pretty significant shift. And you look at here, we'll just pay attention for simplicity's sake for the S&P 500. But we've got, 33% of the index has had a positive return. 2/3 of the index members have had at least a 10% drawdown, which is what Liz Ann was talking about. And then 52% has had at least a 20% drawdown from their 52-week high. And that's pretty important when you look at the internals of the market. And so, I think this gives me maybe a little bit more comfort here that, obviously not all index members have moved to the same degree, but some have clearly corrected from a high, and this has been influential to the market itself. And I think it does set up some positive recovery once the cloud of ambiguity lifts somewhat. I thought this was really interesting out of Goldman Sachs, and it plots the trends in economic growth. That's on the left-hand axis, and then the upper axis there you see real 10-year Treasury yields. So, and the little dotted circle there kind of represents where we are right now. And you can see the impacts on the market from these different scenarios. And this goes back to 1975. So it has some relevance here. And the sample size is certainly large enough that this has meaning. So obviously when things are accelerating, regardless of the yield environment, you expect large returns. And you expect large returns when growth is stable, even when regardless of what the Treasury is doing, as long as you have accelerating or stable, you're doing pretty well. But we are decelerating right now. Again, we just showed you that chart where the expectations are for essentially 1.6, and that's down like 3 percentage points from where it was for the first quarter, just like literally a month ago. But by and large, in any kind of yield state, if you're decelerating but you're still growing, you can exhibit positive returns. And this 8% here under rising yields really represents where I think we are. And obviously rates are rising, we are decelerating, but we are still growing as well. And I think that's important to mention. It's just that when we start contracting is when we get these drawdowns in the market. Here's a plot of the American Association of Individual Investors sentiment, their Bullish Index. Obviously that's down, that's in the white. You can see the arrow there. So less bullish now because of everything that's going on that we've talked about. And on the blue, you can see the put option volume. And so a put option is acquired by somebody who is fearful that the market is going down, and they actually want to either profit from the market going down, or they want to provide some kind of downside insurance for their own portfolio. So they buy a put option so they benefit if the market goes down, which in the case of portfolio insurance, it just helps to offset some of the loss and mitigate that loss somewhat. So when you get in a time where people are really anxious and really nervous, not only do you see the bullish indicator go way down, which it is, but you also see this put option volume go way up, and that's where we are now. And I think, this is almost a contrarian indicator here in the sense that it does suggest a reversal to a mean, if you will, at some point. Well, as we talk about style, we've talked a lot about how value seems to be a little bit better positioned in the current environment. And again, if you assume that we're decelerating from a higher rate, but we're still growing, and we're moving into kind of a maturing economic cycle, if you will, then that tends to favor cyclical exposure. And in this case, value has a lot of benefit here. And so you can see that institutional investors right now are, they're more bullish on value than they've ever been. Again, this is something to watch, maybe with some level of enthusiasm, because obviously if people are moving money into value, you don't want to be left at the train station. But at the same time, you've got to watch out for overcrowding, if you will, which might increase volatility of value-oriented investments. But clearly, we've shifted some of our portfolio into the value sector, and I think that is pretty much in line with where this survey is pointing. So the Nasdaq, looking at that, this is price to sales. So you're dealing with companies of all sizes, and even some that really, where earnings aren't necessarily the best barometer in the Nasdaq. But on the price to sales basis, considering the dramatic correction that we've seen in Nasdaq, in the index itself, you can see how that's impacted the price to sales ratio. And what it was doing is it's getting us back to pre-pandemic levels, which arguably are not necessarily cheap by long-term standards, but I think certainly it looks a lot better than it did really in the aftermath of the the lockdowns and then that recovery where these ratios got completely out of whack. They're just more normalized right now. Here we've got the Nasdaq 100 2-month rolling change. And again, just to underscore how significant beat down we've seen in the Nasdaq, this 2-month percentage rolling change is as low as it's been in really almost over a decade. It's extremely profound. Again, there are obviously reasons why we've seen a beat down in the Nasdaq, but you know, typically you don't see something of this magnitude. It's an interesting chart that I found because this plots basically non-profitable technology stocks in the amber line against the 2 to 10-year bond spread. And so when you think about like when the 2 to 10-year bond spread is increasing, then that tends to suggest an expansion in the economy. You know, in this case, there's different things going on. I mean, obviously, longer term 10-year yields aren't moving higher because there is some anxiety over whether the Fed's going to make a big mistake and then wind up slowing the economy. But I think there is, you know, a general feeling too that, you know, maybe inflation stays a little bit higher, and so we need higher 10-year yields. But you can see that there actually is a relationship here, and so once we saw the non-profitable tech stocks begin to roll over and correct. That's about the same time with a little bit of a lag that we saw the spread between the 2 and the 10-year tightening. So kind of an interesting chart here. Here is the option adjusted spread. So these are credit spreads for fixed income. So when you think about credit spreads, you think about the difference in yield between what we call the risk-free asset, which is a U.S. Treasury, and whatever the instrument is. It could be a corporate bond. It could be, you know, it could be a municipal bond. But in this case, this is the corporate average option adjusted spread, and that sounds like a techie word, but it really just means this is a proxy for how investors view risk. And so when this number is moving higher, which it has, investors are pricing in an increase in the overall risk backdrop. So with that, you know, we just showed you the 2 to 10-year spread, and here is the institutional survey. Again, we've drawn on B of A for several charts today, but in this one, it just shows you that the expectations for a flattening yield curve have actually increased substantially over the last year. And again, you know, if you take the really bearish view, that would tend to suggest that you get some kind of a recession. I think in this case, it is, you know, more of a function of, you know, this anxiety over whether the Fed is going to make a policy mistake and raise interest rates too fast, too soon. But clearly the investor world is expecting a bit of slower growth. This is out of RSM, the share of advanced economies and emerging markets with inflation above 5%. So when you think about this under you know, advanced economies, which is the red line, 44% of advanced economies have inflation over 5% right now. Now, however, when you go down to the emerging markets and developing countries, you know, countries that are on the rise, they're not emerging, but they're not developed either, or fully developed, I should say. That number is much higher, 71%. So again, you know, there is a lot of inflation around the globe. It's not just a U.S. issue. As you can see here, that there's quite a few other areas of the world that are going through this kind of issue. Here's the U.S. Consumer Price Index, and you know, we've seen lots of charts on inflation. This one is obviously no different, but I came across it, and it's really good from a historical perspective's sake. And so think about financial planners and how they build in risk into their models. And historically we've used this kind of 3% rate. You can see the solid line here is actually 4% inflation, which given the circumstances now is I think just as apt a barometer as anything else. But you can see inflation for a long time kind of got saddled in that 3% level, is kind of gradually eased off, and now it's kind of punched back through that 3%, and in fact, punched right through the 4% as well. And you can see that that we have had that at various points in the past, and typically we see this kind of associated with the recession. Here, if you look back at 1975, we had basically a lost decade of sorts before inflation was gotten under control in 1982. But just suffice it to say that we've been here before, but this chart provides really good long-term perspective. So in this chart, we look at U.S. consumers. You can see household net worth is in that light blue. In the darker line, you got the personal savings rate. Obviously, with an increasing stock market valuation and home price values continuing to move higher, household net worth of percentage of disposable income continues to move higher. And you can see the trend line there. Now, on the savings rate, once we've move past these transfer payments, savings rates going down because consumption's picking up, and consumer still has a lot of dry powder, as you can see here, available to spend. Now, net worth doesn't always mean it's liquid. It could be tied up in your house or whatnot, but I think overall it's suggestive of dry powder that consumers could put back into the market. So personal savings rate, really the keynote here is that even though it's come down because of consumption, it's still actually well above kind of this near-term trend that we've seen, or interim trend that we've seen over the last decade and a half. So I'm going to end on this. This is a visual depiction of what I think we all knew already, is that we were on kind of a general upslope for several years in beer, wine, and liquor store sales until we got to the pandemic, and we had a really big spike, and that growth rate has continued at this higher level. So just kind of interesting to see kind of what happens when you get locked down and you can't socially aggregate. You would expect this number to have gone down maybe somewhat back to a trend line, but it's actually stayed pretty lofty levels. Pretty interesting. So that's all I've got for the pack this week. I hope you have a wonderful week, safe week, and on behalf of the entire team at BKA Wealth, look forward to talking to you again soon. Take care.